Welcome to this lecture on the introduction to fundamental analysis. There are two types of analysis that I need to take note of. Number one is the technical analysis, which they've gone through with you. And then the second one is the fundamental analysis. So a lot of people ask, is fundamental analysis better or technical analysis better? Which one should I use? Or should I use both? There's no right or wrong because there's tons of debate about which one is better, and the debate is still going on. So personally for me, I try to use both as much as possible. But today I'm just going to go through briefly on each of the economic factors and political factors. I'm not going to go deep into it. But first thing first, what is fundamental analysis? It's a study of how political, economic, social, and news events affect the movement of the currency markets. So you can see that there are many things that can move the currency market. Political events like elections, economic data release, social events, and even random events. Just like natural disasters and wars, which we can't predict. So there are two types of events that you need to take note of. Number one are the predictable ones, which are the political economic events, and the unpredictable ones, which are natural disasters and wars. So overall, if the country's future or current economic outlook is positive, the currency value will increase or strengthen, and vice versa. So why is it that the currency value will increase when the economic outlook is positive? Because when the economy is very good, more businesses and more foreign investors from other countries, they will want to invest in that country. So what they'll do is that they'll purchase the currency to buy those assets, which leads to the currency strengthening. So especially if you're a scalper, day trader, or swing trader, it's better to avoid trading during major news events. Because during major news events, your technical system will be rendered useless, meaning that it does not apply to high impact events. No matter what system you use, it will not work out when there's a high impact event. So of course, there are many economic factors that can affect and move the currency markets. But let's just focus on a few main ones that has one of the highest impacts on the movement. So the first one is interest rate changes. Federal Open Market Committee. So basically what it is just a community within the Federal Reserve System. So the other one is unemployment rates, or in other words, the non-farm payroll. So when does the non-farm payroll occur? On the first Friday of every month. Okay, to be specific, Friday night. So make sure that on the first Friday of every month, you wouldn't have an open trade, especially if you're a scalper, day trader, swing trader. Okay, unless you have good research on it, I wouldn't recommend trading the non-farm payroll because a lot of people like to scalp the big movement only to get burnt by the NFP movement. Okay, so some people also call the non-farm payroll NFP. The other one is inflation rates. So in order to monitor inflation rate, you just look at the consumer price index, okay, CPI, consumer price index, or the PPI, which is the index of industrial prices. Okay, later on I'm going to show you a platform where you can monitor all of that in one shot. The other thing that you should take note of is the trade balance data. So what is the trade balance? It's the difference between the imports and exports of the products and services for that particular country. Then the other one is the retail sales data that you need to take note of. As the name implies, it tells you the changes in the volume of the retail sales. Or in other words, it shows you the amount of consumer demand or the strength of the consumer demand for that particular country. The other one is the gross domestic product rates or the GDP rates. So GDP, what does it mean? Is the sum of products and services that's produced by that particular country. And of course, there are two types of GDP, the real GDP or the nominal GDP. I'm not going to go detail into that for right now, but for now, you just need to take note of the GDP rates, okay, because it's going to have a significant impact on the currency movement also. And of course, you need to take note of the industrial production index also.